And thank you very much, Debbie, for being the consummate host as always. As Debbie was mentioning, I run a company called Juno. And the really quick backstory on that is 5 years ago, I had to get loans for business school. And at that point, a few classmates and I started an experiment. And we said, hey, if we can bundle together a bunch of our classmates who need to get loans at the same time, could we convince different banks and credit unions to offer a bulk discount or something better than to the group than if we went to each lender individually? And we were pleasantly surprised that there was a lot of demand for this concept. And so we started it initially just for 10 MBA programs. And now we do it for all schools across the country and increasingly for student loan refinancing. So simply put, we go big groups of demand for a product, and then we get the same people who would normally provide those products to give a better offer to our group than if you go there directly. And so I will pause for 1 second while I restart this and be right back.
Great. We will see you soon, Chris. So anybody want to share in chat what's going on with them, their students, whether or not they've graduated, what year they might be in college, what questions you might already have about the whole student loan pause restarting, what loans you might currently have, or do people have private student loans, or do they have still the federal loans? Do they have a Parent Plus loan? Is it their student has the direct student loans? So love to hear anything. It's a little quiet in the chat right now. Okay. Oh, here's somebody. Daughter left. I was just going to say, who's gone back to college yet? Daughter left college, but has to repay her loan back. Oh, okay. Got it. So she, Amanda, so she left early. So she hasn't finished the full 4 years. I have a son who is a senior in college. Oh, Chris, are you back?
I am back.
Okay.
Sharing the screen, if that's all right.
Yeah.
All right. So I feel like I interrupted in the middle of something.
Oh, no. I was just reading people's chat. I was asking them what's going on. Like what's the status of people. Amy's son is done with college. He has, or I'm not sure, he or she has direct unsubsidized loans, and they're looking for information on consolidating. Somebody else's daughter has just graduated in June. People have federal loans. Somebody has a Parent Plus loan for the oldest son, and who's restarting college at a different university. Okay, lots of good information. Lots going on.
All right, great. All right, if you don't mind, then I think I'll probably just dive in. And as I do, please feel free to liberally use that chat box that Debbie pointed you to before. We'll monitor it throughout and answer as many questions as we can along the way. There's a lot of nuances to student loan refinancing versus federal loan repayment plans, especially for Parent Plus loans. And so happy to answer as much as I possibly can as we go through this.
Wow, sorry, can I just read this one comment, because you were mentioning this, Chris, before we got on. So Darren is saying they have a Parent Plus loan for 2 kids at Nelnet, and they can't get a reply from them. That basically they haven't been answering their email, and the wait time is over 60 minutes. You were kind of mentioning, what might be going on at these servicers now that everything is starting back up.
Yeah, I think some helpful context for everybody is it's been 3 years since there have been any student loan repayments on federal loans. And to put it nicely, the servicers and the Department of Education have not built the capacity to serve 40 million people coming back into repayment at the same time. And so the reality of the situation is, I've been hearing this a lot over the last 2 weeks, getting in touch with your student loan servicer right now is just incredibly difficult. And so hopefully we'll be able to provide you with answers to some of the questions that you might otherwise ask them. There's a slide here later on some digital ways you can get in touch with your student loan servicer in case that might be quicker than giving them a call. But if you feel like you're stuck in an endless loop of being on hold, you're not alone. It's just the reality of the situation right now. Hopefully that dies down over the next couple of months. But if not, then we'll be happy to be a backup resource for anything that we can be helpful for. Over the next 20-30 minutes, here's just a couple of the topics I'd like to cover, and then I'll just make sure that we save as much time for questions as possible. So first, we'll start with a really quick overview of how student loan refinancing works. A bit of an overview on who's eligible, when you're eligible, some of the key reasons why people choose to refinance, some of the key things that you should keep in mind that might guide you towards not refinancing those loans. We'll switch over to a second section about some of the math behind this. So what rates are people actually getting today? How can you compare those rates to what you currently have? And a quick section on a new repayment plan for federal student loans that was just released in the last couple of weeks. But has some very interesting implications, especially for Parent Plus loans that you should know about. So just to dive in, I gave the quick intro on Juno and myself at the top of the call, so I'll just breeze through this. But the one thing I do want to just call out in this section is Juno's a very simple mission. We think the more people you aggregate who need a product, the lower you can bring the price to get that product. It's a very simple concept that works across industries. It's just that people don't tend to do that for financial products. And so if you are already considering refinancing your student loans at different places, I just want to call out that often you might be looking at using a student loan refinancing company that we've already partnered with. And just using Juno's version of the same link can get you a 0.25% lower rate than going to that same lender's website directly. In some ways, my mom calls it AAA for student loans. We call it group bargaining. But just know that if you're already looking at this, I would just ask you to at least check our site first to see if you can get the same exact product, just cheaper. Now, with that, I'm just going to move on to what is student loan refinancing and how does it work? At its most basic level, it's similar to refinancing a mortgage, but simpler. So all you're really doing is taking a new loan that will pay off the old loan in its entirety, and that new loan might have different rates and a different payback term than what your old loan had. You'll have a lot of options on what you can choose, and we'll get into that in just a minute. A few of the things just to keep in mind before we move on here. Unlike refinancing a mortgage, you don't have to get an appraisal on a home or take additional steps. It actually can be a completely online process where you typically are just providing your proof of income and your credit score in most cases, as well as a little bit of information about your existing student loans. And then everything from there is effectively automated. You can also refinance more than once. And so a common strategy for people who are truly trying to optimize their finances is if they decide that refinancing is for them, and again, we'll get into that in a minute. Whenever somebody gets low enough, something lower than what they're currently paying, they'll try to refinance again. And so rates might be high today, but if the rate that you're getting offered is lower than what you're currently paying, it makes sense to still refinance today. And even if rates go down a year from now, you can refinance again without paying any penalties. There's no prepayment penalty or application fee. It's a pretty seamless process. So you should just have this in the back of your mind as it's a flexible option that you can do more than once with limited work. but it's not absolutely right for everybody.
Chris, sorry, can I ask a question on the slide right before?
Yeah.
Just because I know a lot of people on the call are parents, is one of the benefits also of refinancing is it at that moment, or that the parent could possibly come off as a cosigner?
You are stealing my thunder, but yes.
Sorry. Okay, because the U part to me was like, oh, it's only meant for the student, but in this case, the U is really the student and the parent who have co-signed that original loan.
Yeah, exactly. I'll get into that in like 2 minutes,
Okay.
but that's one of the 4 key reasons why it can make sense. Why can you get a lower rate? 2 reasons. One, say the market has actually moved compared to when you took out the first student loan. Now, that's not going to be true for the vast majority of people, because it's not likely that you took out loans at a time when rates were higher than they are today overall in the economy. But the second reason is, as soon as you or your student have graduated, they are viewed as significantly less risky by the vast majority of lenders. And so once they've signed a job offer, or once they've started work, there's a whole host of lenders who will provide that student the opportunity to refinance that, because now they have income, now they can make on-time payments, and there's less risk associated with getting that money back. Who's eligible to refinance their loans? Let's just flip to this slide. It's going to vary a little bit from one lender to the next, but there's 2 buckets of folks to think about. One is, say you or your student have already graduated. If that's the case, then that's great. But if you haven't graduated yet, as long as you're in the final semester or the final quarter of school, and you have a job start date, so basically a signed job offer that is within 6 months of the day that you want to refinance, with many lenders, you can do so. That changes over time. There have been periods in the past when you had to already be working full-time in order to refinance. Just know that if it's the final semester, then you can likely already refinance. Refinancing is also a little bit stricter on credit requirements than new student loan origination is. So lenders typically require you to have a FICO score of 680 or above, or a cosigner with a FICO score of 680 or above. That can be flexible, but just keep it in mind. And the documents that you typically need in order to process a refi are either an offer letter for a job, or the 2 most recent pay stubs for the person whose name is going to be on the refinance loan. And if it's self-employment income, typically you'll actually need to have 2 years worth of either pay stubs or tax filings in order to qualify. And back to Debbie's point, actually, there's 4 reasons why people look at refinancing. So the first is the simplest. It's if you qualify for a significantly lower refinancing rate than what you're currently paying, which can especially be true if you borrowed any PLUS loans or undergraduate private loans, then this can be a great way to reduce the amount of interest that you're accruing every day. And it also would allow you to potentially pay off that loan faster without changing your monthly payment. So one strategy people take is to say, I'm actually comfortable with the amount that I'm paying off right now, but I have this opportunity to refinance to a lower rate. And as long as I'm making a similar payment to what I make now, I might end up paying this loan off 5 years faster or something like that. Reason 2, and is incredibly important for a lot of parents, is the ability to release a cosigner from the loan. So 98+% of undergraduate private student loans have a cosigner. And the vast majority of the time, the cosigner is one of the parents of the student. So some lenders will have, let's say that's that situation. Some lenders allow you to be released as a cosigner after a certain number of monthly on-time payments are made. But you're still stuck with whatever rate you got when you took out the loan at the beginning. In a lot of cases, you're going to be better off just refinancing that loan. It achieves the same outcome, but you can often do it much sooner than if you wait for that lender's cosign or release policy to kick in. And you can often reduce the rate that you're paying on that loan. So if you do have any cosign loans, especially for undergrad, this is certainly something you want to consider. See one quick question here on, is it possible to refi a student parent cosign loan while the student is still in college? To refile, for example, a loan taken in freshman year during the student's junior year. John, this is a fantastic question. So today it is not, but I know that starting next fall or next summer, most likely, there's at least one lender who is going to pilot this. I think it's going to start with eligibility in the state of Texas and hopefully beyond that, because that is the ideal scenario. If you can, let's say you had taken out a loan in freshman year, a private cosign loan, it may be possible very soon to let's say take out another loan in sophomore year that pays off the first loan but accrues at a lower interest rate. Two more reasons why it might make sense to refi. I'll have a slide on this in just a minute, but a lot of people over the last 2 years, the last 3 years, took variable student loans. And at the time, it sort of made sense. Jay Powell, chair of the Fed, said at one point in 2021 that he didn't expect rates to rise for a very long time. And you were able to get variable student loans that were as low as 2% in some cases. So we saw a mix shift of, before that, 90% of people took fixed rates and 10% took variable. But then there was this window of time when rates were really low, where about 50% of people took variable rates. Now, things have certainly changed since then, much more quickly than anybody expected. And a lot of people who currently have the variable rate private student loans should be refinancing those. And in many cases, they actually haven't checked what the current rate is that they're being charged. In 2 slides from now, I'll give you just a quick snapshot for how you might be able to estimate that for yourself. And then the fourth reason why people refinance is, in some cases, people will have taken out a loan and they selected a 5-year repayment. So as for private student loans, you can typically choose if you want to repay it over a window of 5 years to 20 years. But once you select it at the beginning, you're stuck with that choice. Let's say somebody who's graduated now, it's 4 years later. Some people look at that bill and say, hey, actually, I don't want to pay this off over the next 5 years. That monthly payment is too high. And so maybe I want to refinance it into something that has a longer term than what I initially selected. I'm going to spend 2 really quick slides just trying to illustrate a few key points of what it might make sense to refi. And then we're going to flip into an honest conversation around when it does not make sense to refi. So if you've taken a federal plus loan, and especially a parent plus loan, over the course of the last 2 years, you would have paid 7.54% for loans that were originated from July of 2022 through the end of this June, or 8.05% is the interest rate on any loans that have been originated since July 1st of this year. And the orange bar that you see on this chart is actually the median 10-year fixed refinancing rate that our member base has reported receiving over the last 2 months. So the sample size of a couple of hundred people. In a few slides, I'll give you a little bit more data on that so you can see where refinancing rates are without having to go check a bunch of places. But the key takeaway is, even though rates are quite high across the economy, people are still often getting quoted rates that for refinancing are 1.5% to 2% lower than some of the plus loans that they would have most recently taken out. This is really just an illustration of the point that I was making 2 minutes ago. A lot of people took out variable rate loans. And forgive me if nobody on this call did, because then I would be wasting your time. But the way variable rate loans work is you were quoted some number back in the day when you took it out. Say it was 2%. And in the fine print, that 2% was defined by a formula that said SOFR plus X point X percent. SOFR is a number, is what you see on the right-hand side. That's the overnight lending rate for banks to one another. And so if you took a rate that was, let's say, 2%, then your, what that kind of means is SOFR back then was 0. So back then the formula was 0 plus 2%. Today, SOFR is 5% higher. And so your rate's actually 7% and climbing. For some people that I've spoken to in the last 2 weeks, they hadn't actually checked what the rate was on their variable rate loans in a year or two. And we're surprised to see that what they thought was a 6% loan was actually now accruing interest at 11%. If there's one takeaway from this, it's if you have a variable loan, please do make sure to check what the current interest rate is that you're paying. And if it is extremely high, you are quite likely going to be very happy when you refinance it. Here's some key reasons why you might not want to refinance. So if the rates that you're getting offered in the market are not lower than what you're currently paying on any of your loans, don't refinance them. It just will not make any sense whatsoever. And for some percentage of people, that's going to be true, depending on what rate you're currently paying on the loans that you took out. If there's any chance that you, or let's say the student who's the borrower, might qualify for, let's say you have federal student loans and you're working in a not-for-profit environment, then if you refinance those federal loans, you're going to give up on the opportunity to claim public service loan forgiveness, which after 10 years of working in a not-for-profit setting means that your entire loan balance is forgiven. And depending on how much debt you have and what your income is, there may be an opportunity to use a new federal loan repayment plan called SAVE. I'm going to walk through it in a few minutes towards the end of this presentation because it's a little bit complicated. But there's going to be, this plan was just released. There's a pretty big bucket of people for whom using the federal SAVE plan is going to be a better outcome than refinancing. And specifically for Parent Plus borrowers, there's a small hack that you should know about that your servicers will not tell you about, but we will. We'll spend 2 minutes just on some very common questions that we hear about refinancing. And so, do you need to be a US citizen or permanent resident? We get this question a lot from grad students. Not anymore. So we have set up a program with one of our funding partners to be able to refinance student loans for international students who are now working in the US full-time. If you have any questions about that, there's 2 people on our team who are dedicated to just focusing on that product. Can you refinance just your private loans while not touching your federal student loans? And absolutely yes. When you think about breaking down a decision tree for refinancing, there's a lot of questions about whether and when you should refinance federal student loans. And we'll get into that in a minute. But when it comes to existing private student loans, my sincere opinion is that anytime you can find a lower rate than what you're currently paying on those private student loans for a similar term length, you should refinance those. You're not giving up any protections. You're not giving up anything in this process. The only person who loses a little bit is the original person who gave you that loan and would prefer to be receiving higher payments for a longer period of time. The only person who truly wins is you. So if you have private loans, you really should look at refinancing those. And then if rates go down, look at refinancing those again. And I won't get into this grace period piece at the moment, but there aren't any fees when it comes to student loan refinancing. Years ago, there were some lenders who charged fees. Today, there are no prepayment penalties. There's no application penalty, application fee or origination fee on student loan refinancing from any major player. And so whether you're checking any of Juno's partners or you're doing your own research and finding a different refinancing company, make sure that there are no fees, because if there are, it's a red flag, but you should rest relatively well assured that there won't be any. And that's part of why, if you want to optimize your finances, it will make sense to refinance more than once as rates go down. And the last commonly asked question is simply if you need multiple applications for multiple loans. And simply put, no. It's 4 years of undergrad. There, you might have 4 different private student loans, let's say 2 from Sallie Mae and going to make it up and say 2 from Discover. You only need 1 refinancing application to be able to pay off all 4 of the original loans and now have a single lower monthly payment than those 4 combined. I'll pause there just in case there's any questions before we dive into some of the numbers around the rates that people are actually getting, and then some of the tips and tricks about how you can take advantage of the federal SAFE plan for Parent Plus loans.
Chris, I have a question.
Yeah.
What about if my student has graduated college, but has now gone on and is currently in graduate school? What's the scenario of being able to refinance the undergraduate loans, considering that they're graduate students?
It's a great question. So are the loans in the student's name, the parent's name, or both?
I'm assuming, let's say they're both. They're still both in the parent's still the co-signer on the undergraduate loans.
Got it. Then you can refinance, but you'd have to still co-sign the refinance in order to remove yourself as the co-borrower on a co-sign loan. The student does have to be within 6 months of starting a full-time job. And so let's say if this is something that you're already preparing for, you can refinance now before they're in school full-time, or you might have to wait just until that last semester of school in order for them to have that job start so that they can refinance on their own.
But let me just ask one more follow-up. Can I, if I'm willing as the parent to stay on as the co-signer, can we still consider refinancing if we can potentially get a lower rate?
Yes, with some lenders and no with others.
Okay.
Question. Actually, honestly, with most lenders, the answer is yes. And you still would be able to refinance that one again when they graduate without any penalty.
Okay. So somebody's asking a question that they took out the federal loans and they're just trying to clarify that when they took out the federal loans, the rates were on the lower side, and they're not sure if the federal loan rates are fixed or variable.
All federal loan rates are fixed. And if you took out Parent Plus loans or any federal loans in 2020 and 2021, candidly, odds are that you will not want to think about refinancing those.
Yes, this person's actually telling me that their rate was 2.75%. So that's pretty good. And that is for the life of that loan.
That is for the life of that loan. Please don't touch that one.
Yeah.
But that actually brings up an interesting point that I forgot to touch on. You can choose which of your federal loans you want to refinance and which ones you want to keep. So the rate on, so that 2.75 would have been the rate for an undergraduate direct loan in 2020 or 21, if I'm not mistaken. which means the rate on a Parent Plus would have been somewhere
5 something.
5. Yeah.
Yeah.
But in 2019, it was a lot higher. I think it was roughly 2% higher. In 2018, the Parent Plus was 7.6. And so if that was the situation, then my recommendation would be that you look at each of your Parent Plus loans, each of the loans that you have individually. Just understand what is the rate on each one of them that you're currently being charged. And when you get a quote for refinancing, just check if the rate on your refi offer is lower than some of your loans, but not all of them. Make sure to only refinance those specific loans that the rate is lower than. There's no obligation to refinance all of your loans at once. It's a little bit more complicated, and I can understand there's a little bit of headache involved from having multiple servicers to keep track of. But it is to your advantage to just selectively choose which ones you want to refinance. That actually brings us to a good point here on trying to figure out what your rates currently are across all of your different loans. And so common question we'll get is, how do I actually figure out what I'm getting charged? And so I know we had some questions earlier about contacting your loan servicer. Step 1 is to actually figure out who your loan servicer is. And so your loan servicer will maintain data on your current loan balances, what repayment plan you're currently enrolled in, and the current rate you're being charged on each of your loans. You might have a different servicer for each federal loan that you have. So just important to keep that in mind. The way you can check what federal loans you have outstanding and who your servicer is for each one is to sign in to studentaid.gov using your federal student aid account. And it's the same account that you likely used or made when you filled out FAFSA in order to be eligible to take out those federal student loans. That is right now by far the fastest way to get through. If you want, you can call the hotlines directly. So I put the number there just below in case you'd want to. But as somebody alluded to at the beginning of this webinar, the wait times are worse than flight cancellations on Thanksgiving Eve. Not something that I'd want to put anybody through. If you can get through digitally, do that. Otherwise, realistically, you're probably going to have to wait until sometime in October or November for the rush in demand and the increased wait times to go down. Here's a really quick sneak peek just at the types of rates that people are getting today. And so this is based on a data set of rates that some of our members report to us that they are getting from a couple of different lenders that we work with. And so what I've broken this down by is by term length and by FICO score. And some people will get much lower, some people will get much higher, but these are medians across each bucket. So I'm not going to even think about showing the variable because I think variable rates in general are a little bit dangerous right now. People are reporting getting fixed rates that are between, let's say, 6 and 7.5%, depending on the term length that they're selecting. And as you really expect, the shorter the term length, the lower the rate. If you zoom in on the 10-year fixed rate, which is the most commonly selected way that people repay their loans, depending on your credit bucket, and I've broken it down here, your rate's going to be likely somewhere between 6 and 6.4% to refinance that. And so if you've got an existing private student loan, especially for undergrad, it is highly likely that the rate you're being charged on that is above this 6% range for a 10-year loan. If you've got an existing federal Parent Plus loan and you took it out over the last 2 years, it's quite likely that you'll be able to refi to a lower rate than what you currently pay. But if you have federal Parent Plus loans from 2020 and 2021, it is quite unlikely that you'll be able to refinance those at rates lower than what you currently have. Please stop me if there's any questions on that, so it can get a little bit complicated. The one additional point I'll just add here is if you are a Texas resident, there are lower rates that are exclusively available to you. The reason why is there's a Texas-based nonprofit called Brazos that we work with really closely now. And they're able to fund their loans using state bonds, and they have no profit goal. So they are able to provide rates from 4.85% to 6.95%. And that 6.95% is literally the highest rate that they offer for a 20-year fixed rate payback. And so that 4.85, by the way, it's literally less than what a lot of folks will get on a high yield savings account today. And it's only possible because of how that nonprofit is set up. So if you are a resident of Texas or your student is, please do make sure to look specifically for that one. It is not.
So, I'm sorry, Chris, there's a question about what you just said about the Texas. Is that for Texas residents or is it for students that are going to school in Texas?
Great question. Students, Texas residents. So you could have gone to school anywhere. And as long as you currently live in Texas, you have access to those rates. Here's just a really quick illustration of how the math works if you took a federal plus loan in 2022 or 2023, and if you were able to refinance at 6% instead of paying what you otherwise would be paying, 7.5 or 8%. And so realistically, you can lower your payments monthly if that's the refi rate that you get by, let's say, $65 to $90. And over the course of the 10 years during which you'd be expected to pay that off, that can equate to $7,600 to $10,000 overall. So sometimes that percentage difference doesn't seem very small, but in total dollars, it starts to become very meaningful money. There's a tool that we put together just for everybody so that you can just quickly do this math without having to do anything. And so there's a link to it here. Very simple. All you got to do is put in some assumptions around your existing loan balance, the average rate on those loans today, and then some basic information on what you're getting quoted from any refinancing company. It can be one of Juno's partners or somebody else. And we'll just very cleanly provide back what the overall savings would be. And if there is no savings, we'll also tell you the same thing. So you can use that as your, let's say, checking what your rates might be across different places to get a quick sense for whether this is something that makes sense for you. The last section I want to talk about is the new federal SAVE repayment plan. And out of curiosity, I'm just going to take a quick look at the gallery. How many people here do have Parent Plus loans? Okay, I actually can't see the gallery view, but Debbie, do we have any hands? Okay.
A few people are saying yes in the chat. Oh, the people aren't raising their hands, they're just saying yes in the chat.
Okay, so there's a little bit of a hack that you have that you can take advantage of until July 2025, and then it's gone. So
it's an important hack.
This is very, very important. Your servicer is actually not allowed to tell you, but I'll guide you to some resources that do explain it better. So first, what is the Federal SAVE program? It's a new repayment plan that exists for federal student loans that it's an enhancement of existing income-driven repayment plans, but it's actually an enormous enhancement. So when you use this program, you're limited to paying, basically the amount that you have to pay monthly on any loan balance is limited to either 5% or 10% of your discretionary income. So if all of your loans are undergrad, then you only pay 5% of that amount of your discretionary income. If some of your loans are grad, then you pay 10% of your discretionary income. Now, what is discretionary income is also not intuitive. The way it works is the federal government publishes poverty guidelines. So for each state, there's a number, and depending on the number of people in your household, let's say it's like one person in a household in California, then that number is something like $22,000. Under the SAVE plan, the new rules say that whatever your discretionary income is equal to, let's say you make $100,000 and you're a married couple with one kid. In most states, only $40,000 of your income is considered discretionary. It's a little bit of a complicated formula, and there's the calculator that we built that I'll link you out to. But what it really means is the vast majority of your income actually gets shielded from being considered as part of these payments. So you can make $100,000 a year, and no matter what your graduate student loan balance is, it can be $1 million, you'd still only be paying 10% of $40,000 as your annual payment through the federal SAVE program. Now, in other existing federal repayment plans, if you are tying your payment to income, but the amount that you're paying monthly doesn't cover the interest that's accruing on your loan, you end up with these massive runaway balances of interest on interest on interest. This plan is different. For the first time, what it says is, as long as you make your required payment monthly, your interest stops increasing. So you might be in a scenario, and something like 40% of Americans are in a scenario where their required payment under this plan is 0. They actually stop accruing interest until their required payment is $1. And so whatever loan balance you start with will stop accruing interest. And if all of your loans are undergrad loans, after 20 years, no matter how much you've paid, even if it's 0, the balance is forgiven. If some of them are grad school loans, after 25 years, the balance is forgiven. Let's see. There's a quick link to this calculator here. We're updating it and making a little bit more easily usable version of it. And happy to send you a copy of it through email as well. But I really do want to just stress how impactful this can be on your overall payments. And the last thing I'll just mention on it. So here's a quick example. While that's playing, let me explain what the loophole is. Parent Plus loans are not eligible for the SAVE program as is. Parent Plus loans have an income-based repayment plan, but I'm just going to flat out say that it's horrible. It shields a much smaller percentage of your income from the payment, and you have to pay 20% of your discretionary income annually instead of 5% or 10%. So the amount you have to pay is a lot higher. If your payments don't cover your interest, it will keep compounding into eternity. There is something called a double consolidation loophole that's only available until July 1st of 2025. But I won't get into the exact details of how it works, because that will probably take 30 minutes by itself. But the bottom line is, I'm happy to send a write-up on how it works, if that's the easiest, or bake it into our calculator. If you have more than one Parent Plus loan outstanding, or more than one student loan outstanding, as long as one of them is a Parent Plus loan, there's a semi-complicated process where you can effectively bundle those loans together twice with the federal government, and then magically they become eligible for the SAVE program. So before you consider refinancing a Parent Plus loan, what I would advise is to check using this calculator what your payments would look like under the SAVE program. And if you fall into a scenario where your payment is extremely low under the SAVE program and you like it, then you'll want to spend really a couple of hours learning about how the double consolidation loophole works. It's not going to be the best outcome for everyone, especially the more income you make and the lower the loan balance, the less valuable that SAVE program is. But in case it is valuable to you, I just want to doubly stress that you only have until July of 2025 to opt into it.
Chris, there was a question about in any of these cases, if the loan amount, is at some point forgiven, is there a tax liability on the loan forgiveness amount?
Fantastic question. So currently, so the answer is yes, no, and maybe. Any loan balances that are forgiven between today and some point in 2025 are forgiven. So in the Inflation Reduction Act, I believe there was a clause put into federal law that put a temporary waiver on any taxes that have to be paid on student loans that were forgiven. That legally expires at some point in 2025. And whether that gets extended or not, no one really knows. If I had to bet, I'd assume there's going to be significant pressure to extend that. And we'll know well in advance. But the way we built the calculator that you'll be able to use is assuming that that amount is actually taxable, that it's not forgiven. And so you can actually see if it were taxable, still, what is the best outcome for you after 20 years or 25 years? All right, I covered the Juno refinancing offers at the beginning of the webinar. Just the really quick snapshot is right here. We really do pride ourselves on trying to be transparent and helpful. And so the way I'd like you to think about Juno in this entire process is I don't want to push anybody to refinance for whom that's not actually the right financial outcome. I hope some of the things that we've spoken about today will help you make a decision or figure out how to best decide whether refinancing or using your existing student loans or changing into a different federal repayment plan might actually be a better outcome for you. If at the end of that, you decide that refinancing is something that you want to do and it is right for you, then I would only ask that you just check your rates through our partners, because they will tend to have already the lowest rates on the market anyway. And then you'll get that additional 0.25% discount or cash back on most of them just for using our link. And if none of what I'm saying actually is appealing and you find something better from somewhere else, I'd also just ask a favor of letting us know where you found a lower rate or a better process and outcome, so that we have the opportunity to learn, get better, and improve. With that, I'll just flip it to any questions that people might have. And yeah.
I have another question, Chris, about just from a timing perspective. And we started talking about this a little bit before we got on the call. So the pause ends tomorrow, right? Or in 2 days on the 1st. So interest will start accruing. Most people do not have to actually pay. They won't have a payment, right, until beginning of October. So right. They may not really realize, but hopefully they do, that the interest is starting to accrue because they don't feel like they have to make the payment yet. So it may be that people are willing to start to take action kind of in October when they see that they have a payment. If I create a Juno account and I go through and get some refinancing offers now, how long are those offers valid to?
Great question. So it depends on how far in the process you get. You can do a really quick rate check without impacting your credit with most lenders. So similar to getting a new loan for undergrad from a private lender, refinancing companies will let you get a sneak peek using the soft credit check. That is not valid for any period of time, so that can change an hour later. But if you go all the way through the point of doing a hard credit check, your rates can be locked for up to 30 days. Now, one thing I would just recommend on that front is I don't have data to back this up or proof, this is just anecdotal. When there's a significant uptick in people who are applying for refinancing, then lenders have the ability to increase their rates. When there's nobody applying, they have to lower them as much as they can possibly afford to in order to hopefully maintain some volume. My bet would be that your rates are probably going to be a little bit lower over the next couple of days or the next week than they will be once a significantly larger number of people start looking into and applying for refinancing. I could be totally off base on that, and every lender might decide that they want to keep rates low and win market share. But I would at least consider doing a soft rate check sooner than later to see if you potentially qualify for something that's lower than what you have now. And if you do, it might make sense to lock that in sooner than later.
So there's another question here about a student who actually is part of the SAVE program, and but he's going to have to start paying on October 1st. And the question is, if as his income might increase, will that increase the amount of interest he'll have to pay, even though he's part of the SAVE program?
So he'll be certifying his income with the Department of Education once per year. And so your income increases in the future, it won't change the amount you have to pay monthly until you recertify your income. There's a little bit of noise around exactly when you have to do that versus not. But I say to put it simply, if your son's graduating now, or let's say recently graduating full time, then their payments are likely going to be based off of whatever their total income was for the last year. And in all likelihood, the amount that they made over the last year is less than the amount that the federal government says is discretionary income. So they probably would be paying zero.
Yes, so they are paying zero right now, but I think they were concerned when their income increases that what they have to pay is going to increase. And it sounds like it will, but it's going to be a little while till it catches up.
Yeah.
Okay. Any other questions? I know this was a lot of information. It was a lot for me. I'm still absorbing it. Actually, Chris, one person asked if we could share the actual slides. So it's if you're willing to, we could put it in the email. That might be helpful for people to just kind of go through and really look at this information again. And because I mean, really the message that I'm getting is that over the next few weeks, you should decide whether or not refinancing is a possible, route that you should go. And then if that is, then go start, getting like a soft credit check and maybe even like an actual, interest offer, and then, make the decision.
Exactly. Yeah. More than happy to share these slides. And we're kind of rapidly trying to build some tools for folks around whether it's calculated for the SAVE plan or for refi or a few different things. Just a general note to everybody would be, if there's something that you have a specific question on that you're not able to get an answer to, please always feel free to reach out to my team. Odds are we've already answered it for somebody else. We're already built a guide or something else that will answer it. And so please do feel free to use this as a resource. Whether you use any of our partners for a loan or not does not matter. Just asking the questions gives me an opportunity to better prioritize how my team spends time. If you have a question, odds are 100 other people do too.
And I'm sorry, I couldn't get off mute earlier, and I was the one asking the question about the student. He is actually a student, and he still has approximately 3 years left for school. He just was offered a good job recently, and he's been there for 4 weeks, and so he's trying that out before he decides if he wants to go back to school more time or if he wants to just continue with the current position that he has. And so the question that I was wondering for him is, in a year when they check his income again, will they go back and charge him back for the interest that he's not being charged for right now under the SAFE program? Or is that not accrued for the moment that he's eligible for the SAFE program?
Great edge case question.
So you're basically asking if they're going to retroactively charge the interest once they find out that his earnings have increased.
Correct. Yes. So currently he is only making approximately $13,000 a year. So he's not making much. But with this offer, there's room for improvement and, or, for a higher income. And so he's on a trial basis for 90 days. And then if that is something that works out, then has the potential to increase. And so I'm wondering, if this works out, are they going to go back and retroactively charge him for that interest?
I'm 99% sure of this. So I just want to add the 1% of plausible deniability, but no. So, and one thing to keep in mind is the amount of discretionary, basically the amount of income that is shielded from being exposed to any payments is, I think for a single individual, I think the lowest it would be is somewhere around $40,000. And so if he's making under 40, even when he recertifies his income, then he would still be maintaining zero payments on an ongoing basis without accruing more interest. And so in this specific case, I think there's nothing to worry about. More broadly, if I believe the answer would be, let's say, even if he was making significantly more, you're only on the hook for basically the amount that you have to pay for gets calculated by your servicer once you recertify your income. And there's just changing rules around the date that you have to do that. And I don't believe anybody has to until some point in early 2024. And so whatever your most recently filed income is, or whatever they're using as the basis for their SAVE calculation, is valid until you are required to recertify your income next year.
Okay, thank you very much. That was one of my worries. We were going to try to scramble the money together and pay off his loans so we wouldn't get in trouble. But that answers a lot. Thank you so much.
Sure thing. Happy to.
Chris, there's a question. Somebody is asking that their daughter has Stafford loans from the last 3 years, which are a mix of subsidized and unsubsidized. They want to pay the interest on the unsubsidized loans so that they can avoid any capitalization. Do they have to pay that monthly starting in October, or can they wait and make a lump sum payment before she graduates, before like the actual capitalization kicks in?
I love this question. This is a great train of thought. You can wait until before graduation. The capitalization will not kick in until
they're about to graduate.
Sure. Yeah, it's a very savvy move. Kudos for thinking through that.
Another quick question about who should be joining Juno, the student or the parent? Does it matter?
Candidly, it doesn't matter as long as you're talking to each other about it. Whichever one ends up joining and then clicks on a link to one of our partners, whatever browser they're using will be the one that has registered that 0.25% discount on any student loan refinancing offers that exist. And so that's really just the main thing to keep in mind. I also see a question here about explaining how the loan forgiveness works after 20 or 25 years. And so the way the rules are written for the new SAVE plan, if all of the loans that you want to enroll in the SAVE program are from undergraduate, so meaning whether it's a direct unsubsidized, direct subsidized, or other loan, then there's forgiveness after 20 years. If you're combining, let's say, undergrad and grad loans, or you're only enrolling federal grad loans into the SAVE program, then forgiveness happens after 25 years. And there's one more small wrinkle here, which is if the loan balance is $12,000 or less, you actually get forgiveness after 10 years instead of having to wait 20 or 25.
Okay, any other questions? Oh, okay. Well, again, I think there's a lot of good information tonight. People have a little bit of time to let this soak in and let people do their research. We will send a follow-up email tomorrow with some of these links. Okay, last question. Does the forgiveness apply to private schools? Like, is a distinction between private versus public schools?
Really good question. So it does apply to private schools as well, as long as, so the forgiveness applies to the type of loan, not the type of school it was taken out for. And so as long as it's a federal student loan and it's enrolled in that program, it can be forgiven.
Well, thank you, Chris, for all of the information tonight. So let's see, last question. Lynn's asking, does Juno offer any support to help make the federal parent loan eligible?
Probably eligible for the SAVE program.
Yeah.
So we're trying to put together a guide on this right now. In the meantime, in one of these follow-up emails, I'll make sure that we include a link to another company I've seen that wrote a pretty good guide around this. Nobody has really, very few people have had the opportunity to even try doing it yet, but we'll make sure to put together something comprehensive to provide the support you need to figure out how to do it.
Great. Okay. Well, good to see everybody tonight. I'm hoping and assuming that this was helpful. Again, I learned a lot. Thank you, Chris, for your knowledge. And I am sure a lot of people will be in touch.
Thank you very much. Thank you for being here, everybody, and good luck.
Take care. Bye-bye.